for joining us. I'm Gord Long. I have with me this morning John Rubino, well-known author and publisher of the well-recognized website dollarcollapse.com. Good morning, John. Welcome back.
Morning, Gord. Good to be back.
How quickly the time goes each month. I hope you're having a good summer.
So far, so good. You know, we have another month of it here, and then winter comes early in Idaho, so I'm going to try to make the most of it.
Oh, yeah. You have, what, 3 seasons? Winter, July, and August out?
That's what it seems like if you have a boat. Yeah.
Yeah, I have a boat. I used to live in Saskatchewan, but no, I don't. I live in New England, so I actually have a longer season, but I love it. And I don't have the mosquitoes and the black flies I had in Saskatchewan for what it's worth. John, we have a lot to talk about, so let's just jump in, because you've put out some great articles, as usual, here since we last talked. And really, they center around the magnitude of buying by central banks, activities, what's going on with hedge funds, but generally the distortions that have now come into the markets. One of your articles you had that now the markets themselves are too big to fail. I thought maybe we'd kick it off with just some of your thinking that you had there.
Well, yeah, governments are acting like they don't think they can handle a garden variety equities bear market anymore. You're seeing central banks now all of a sudden become among the biggest buyers of equities in the world. And this is a huge, huge sea change in public policy, because it's one thing for central banks to buy bonds. They've intervened in the interest rate market forever. But now they're out there buying equities, and they're doing it on a vast scale. You know, the Japanese central bank is owner of half the ETFs in Japan, and they're aggressively buying individual equities now. The Swiss central bank is one of the biggest holders of Apple stock, along with a lot of other brand name equities. And this is a whole different animal from QE, you know, from investing, from governments buying their own bonds back. This is governments buying the industrial capacity of the world. And from a sound money Austrian economics school point of view, it's catastrophically dangerous. And I think, though, from the left, you know, the Keynesian mainstream economics profession probably thinks this is a pretty good idea, because it finally puts government completely in control of the private sector. You know, if the central banks of the world own all the major equities, then they get a say in how corporations are governed, and they get to direct investment by those corporations going forward. And that's a recipe for absolute disaster, or it's a recipe for something that's not capitalism anymore, which is the same thing as saying absolute disaster, because market-based economies are the only method of organizing a society that's been proven to work, to generate progress and wealth and pull people out of poverty. And we're actively doing away with that. So, you know, besides this being an investment thesis, it's also a public policy and a political science and an economics concept that we're talking about. And on almost every level other than immediate stock prices. You know, they're bidding up the price of some of the equities you own. So in that sense, it's a good thing. But in every other way, this is catastrophically bad.
You know, John, it's not just the equities. And as you said, they're buying the bond market. Now they're buying corporate bonds. So they're creating shortages in the bond market. There's not enough supply, even though debt's going up relative to the buying as everybody chases yield. So we've distorted the bond market. We're distorting the equity market. This is a recipe for a huge problem as you get unintended consequences, mispricing of risks, etc. But how do you manage money in an era like this? And I know you had some feelings on that. It was specific to the hedge funds, the problems they're facing.
Well, yeah, if you look at the plight of the hedge funds right now, you get a sense of how distorted our markets are, because they're generally believed to be the smartest guys in finance, people running hedge funds. And you know, they charge fees that are commensurate with their intelligence, or at least what we used to consider their intelligence, because they charge you a lot of money if you're a client of their funds. And so they have to generate a lot of profit in order to justify their fees. And for the last few years, they haven't been. They've been underperforming for instance, the S&P 500. In other words, you could buy an ETF that charges you next to nothing and do better than the average hedge fund that charges you 2% a year up front and then 20% of the profits, if any profits happen. And so you're seeing big institutions pull money out of hedge funds now and go passive, just start buying ETFs. And a lot of brand name hedge funds are either folding or scaling way back or changing their focus. And so this is a really difficult time in that market, and it's not going to get any better anytime soon because governments are distorting markets more and more aggressively by, like we said, buying stocks indiscriminately or forcing interest rates down to artificially low levels, and in general, messing around with the price signaling mechanism of free markets. So if you are somebody whose job is to look at, for instance, historical relationships and use the history of those relationships to figure out how to invest money going forward, like a hedge fund manager might be. What you get is all noise and no signal. And so you have no idea how to place bets based on history because the governments of the world are changing history. And so one of the things that you're seeing now that's related to this is a lot of heavy hitters going short the market. They're just throwing up their hands and saying, this is crazy, the market's overvalued, governments are screwing up the markets. Let's short everything in sight. And, you know, it's George Soros, Carl Icahn, Bill Gross. These guys are not perma-bears. They're people who've made money long and short for as long as most current money managers have been alive, and they're as bearish as anybody has ever seen them all of a sudden. And I think a big part of the reason for that is that they don't trust these markets anymore, and they assume that something that they don't understand has to end badly. So the people who've been worried about these markets for years now have some high-powered money on their side all of a sudden, and so assuming these guys are right again, things are going to get really interesting in the coming year.
You know, you mentioned in regards to the hedge funds, the amount of redemptions and withdrawals that they're experiencing because they're not doing the returns. MetLife took out 1.8 billion of decommitted it. AIG $4 billion. CalPERS, California pension plans, have withdrawn I think 1.6 billion. I mean, there has been, and when withdrawn, they have served notice and they're being sold. This is money that's going to come out of the equities. And if you look at it, where are they placing the money? Where are these pension plans? Because they can't get the return, they're chasing yield. In actual fact, they're going into private placements. And the point of private placements, that's not in the publicly traded exchange markets. That's lost money. So the money is actually leaving the equity markets, but it's still holding it up. And there's reasons we just discussed earlier. But also buybacks have been the tradition, and buybacks appear to be a problem now too, right?
Two things. First, besides private placements, which, by the way, are a sector of the market that governments can't actively distort. You know, they haven't yet figured out how to mess with private companies. So presumably there are some relationships there that can still be exploited. And hedge fund money is also flowing into emerging markets again, because that's not someplace where, you know, the Swiss National Bank is in doing crazy stuff yet. And so emerging market stocks and bonds are seeing a serious bid lately. And that's a direct result of the developed world markets being distorted by these government actions. Now, as for corporate share repurchases, that's been one of the things propping up the U.S. market for the past 3 or 4 years. Corporations, they don't really trust the future of their industries, so they don't want to build new factories. But interest rates are really low, so they're being encouraged by governments to borrow. And so they are borrowing, but they're just using that money to buy back their stock. And that's been going on for 3 or 4 years, and it's involved hundreds of billions of dollars, a ton of money flowing into equities and propping up equity prices. But now that flow is slowing down dramatically. Corporations have hit the point where they can't legitimately borrow anymore because they're already as leveraged as they've ever been in human history. There's never been a corporate sector that owed this much money as the U.S. corporate sector does now. And so they're starting to be punished for borrowing money to buy back their stock, so they're not doing so much of it. Buyback announcements are going down at the same time that corporate equity issuance is going up. So corporations are now issuing more stock than they're buying back for the first time really since 2010 or so. At the same time, corporate insiders are selling stock at a record pace. Now these are things that usually precede bear markets, or at least dramatic corrections in share prices. So we're seeing a lot of stuff happen now that, if you're really long equities, should just scare the hell out of you. You know, when Carl Icahn and George Soros are on the other side of that trade, and corporations aren't helping you out anymore with share repurchases, you're in a very dangerous market, and that's what we have today.
But is it too big to fail? And I say that in that the government's spending, and they're printing free money and pumping it into a balloon just to keep the balloon from collapsing. And we're seeing blatant evidence of it. You mentioned Japan and the Swiss National Bank, but how many others are doing it that we don't have visibility to doing?
Now, you know, the Fed, somewhere in the U.S. government is an agency that's buying stocks aggressively right now. They just don't tell us because they lie to us in ways that some other central banks don't yet lie to their people. But yeah, that's the other side of the bear argument. You know, on the one hand, you've got everything that relates to market valuations and rational behavior on the part of private sector actors pointing towards a bear market. But you've got these governments and these central banks over here that have effectively unlimited funds and are on the other side of the trade. They're buying aggressively. So that and terrified foreign capital flowing into the U.S. are two things that, if you're shorting the U.S. market, you've got to be very worried about, because those are big numbers that we're talking about over here. Central banks can, they can buy $1 trillion worth of equities and hardly have it show up on their balance sheets now. You know, they've already expanded their balance sheets by creating new money and using it to buy securities. That another $1 trillion would hardly be noticeable spread out among the 4 or 5 biggest central banks of the world. So there are big forces contending out there. And we've never been here before, so you can't say anything with certainty, except that chaos is the inevitable result of all this stuff that's going on. And you can't say anything about the timing either, because this might go on for a while, or something might happen to blow it up tomorrow. You know, before this video even comes out, we could see a global financial crisis bubbling up. And so this is an incredibly hard time to manage money, because it's not about fundamentals anymore. It's not about the stuff that you learned in business school and in your first few years of studying money management as a junior analyst, about relationships between asset classes and assets within asset classes that give you signals about where to put your money. That stuff doesn't work anymore. And if those are your only tools, then you've got a real problem, because you don't have the choice of not deciding what to do with your money. Your job is to do something with it, and inaction is still a choice. So you could go all to cash, but that's a position, and that might not work. So I don't envy professional money managers, and I think for most of them this is going to end really badly, because when your old tools don't work and you don't have new tools yet, it's highly unlikely that you're going to make a perfect set of decisions while you're learning about this new world.
John, my sense is that the market has become, and I'll probably alarm people, a giant Ponzi scheme. And everybody knows Ponzi schemes keep working as long as new money comes into the market or comes in that's bigger than the money that's being taken out. And any kind of disruption where there's acceleration of money taking out causes big problems. In this case, it's not about money coming in. I don't think the markets are no longer markets. What the markets are now is really fundamentally a game of propaganda, and it's about the input is the narrative, and it's controlling the narrative. And to make that really clear is, if the stock, I talk to people and they say, hey, things are fine. I said, they can't get jobs, or they can't make ends meet, their credit, but things are good. And I say, why do you think things are good? Even though we got all the factories shut down, we got all, why? He says, because the stock market's hitting new record highs. Their measurement is always that the stock market is a measurement of the economy. But let me say, if the stock market was down 6,000 Dow points, everybody would be talking about that we're in the middle of a depression, and endless proof statements that you and I know would be on the table. So if you're the government, you have really no choice but to control the narrative and control the market, or it's self-defeating. When you're in a 70% consumption economy, the game is over. And I see that narrative continuously, because we spend a lot of time looking at the frequencies of announcements and how distorted they are. Reuters, for example, controls the vast majority of communications, and everybody else just publishes it. So they put out something, and I'm not picking on Reuters, but they put out something as a statement. Everybody takes it as gospel. I just have to control the Reuters news source. It's not like it was before. Everybody sends them to them, and then the publishers decide what they're going to necessarily put out. But you can see the controlled narrative if you really study it. It's propaganda, John, and I'm not a conspiracy buff. I'm simply saying the market is no longer a market.
Yeah. Well, governments have always done stuff like this on a small scale, but this is the first time they've ever done it just everywhere. There's not a single financial market, apparently, that isn't manipulated in some way by someone. Either it's the big banks manipulating the markets so their trading desks can make money, or it's the central banks of the world manipulating the broader markets so their governments can look good. But there's no, actual free market that you can point to and participate in. So this goes on probably until these guys run out of ammunition. In other words, when we don't accept these fictitious fiat currencies that they're just creating and throwing out into the world as having some intrinsic value, when we stop wanting to hold on to a bunch of dollars or euros or yen, and we immediately start converting this make-believe stuff into real stuff, that's when the game ends. And we're not there yet, obviously. Everybody still thinks a euro has some value, or a yen, or a dollar. And so we're willing to take them, and in a lot of cases, just hold on to them. We are willing to hold cash or financial instruments that pay cash, like a bond, as if it's real, as if it represents some kind of real value. And as long as we're willing to be fooled in that way, then governments have ammunition to continue to manipulate the markets. And so this could go on for a while, or it could blow up overnight. And there's no way to know about that. No way to know about the timing, but that's how it ends.
You're exactly right. When you print money, you end up in what I'll refer to as a Minsky meltup, where there's a flight into these equities, whether they're buying them or where the money's going, which is what we have. And it ends with a fiat currency collapse when the money isn't accepted. But the thing to watch for, John, in my opinion, is watch, let's pick on countries like Venezuela, people that are on the periphery that are having problems. And what you find is their stock markets go through the roof because their currencies are absolutely plummeting. And where do they run? They run to the next least ugly. And so they run to the US dollar. So as you see these peripherals failing, and we're seeing them fail, we're seeing them get into deep trouble, they're fleeing into things like the US dollar. But at some point it implodes. I think there's a lot more to run here. And I think we're still on the early stages of this monetary experiment, which is, they're in a game of no return here. But we'll see. But the problem is, and that you clearly point out, something can trigger it and it can break at any point and implode because that's the nature of these kinds of markets. But 2 years from now, we could be having the same conversation. It's uninvestable, John. That's my bottom line. You can't invest in this kind of rigged game. And that's why I see more and more people going to private placements, money outside the public exchange, real assets, hard assets, but hard assets that generate free discounted cash flow that's measurable, and you can touch it, and the bank can't seize it.
Yeah. Well, that's one of the reasons so much money is flowing into precious metals lately. That is, people are starting to pick up on the fact that governments are actively trying to devalue their currencies. They're not always succeeding relative to other currencies, because that's a zero-sum game. If one goes up, the others have to go down. But it's making more and more sense for people to move some of their fiat currencies into things that governments can't yet figure out how to make more of. And that's been gold and silver lately. And speaking of free cash flow, The mining stocks, the gold and silver miners, have been reporting phenomenally good numbers because they've just come through a depression of the last 3 or 4 years where a lot of them were basically existentially threatened. They weren't going to stay in business if things didn't change. So they cut their costs dramatically. At the same time, oil prices, which is that's a big cost for them, was going down. And now the price of what they're selling is going up. So their margins are blowing out. You're seeing precious metals miners report really low cost numbers and dramatically higher profit numbers and lots of free cash flow. And they are almost alone in this market in having that kind of a trend. Most other industries are either flat or declining in terms of free cash flow. And then you've got the gold miners there with a dramatically positive trajectory. So they're turning up on the momentum screens as well as the value screens now. And that's why they're doing so well. Doesn't mean they won't have a big correction going forward, but it does mean that there are suddenly healthy businesses. And that's a good place to be when you're worried about the health of the rest of the world.
Yeah, and you make a really good point, John. The discounted cash flows, the EBITDAs in most corporations are falling seriously, which is why we have a reversal in the credit cycle. The credit cycle. It's very, very clear. We haven't when your cash flow falls like this, your bond ratings get brought down very quickly, and credit starts to get really tight. Last point I'd make, John, because we have to break, but because you mentioned, this. The currency, fiat currency, and the currency manipulation. We have currency wars. We went through this with beggar thy neighbor back in the 1920s, or at least the 1930s. But don't forget for one moment that Bernanke really believed, rather than beggar thy neighbor, he had his doctrine he called enrich thy neighbor. And that was we needed to have, and he's documented this, that we need, the way to get around that is if you all debase, but you need to work in a coordinated manner. And as you know, we're now printing over $200 billion a month between the ECB, while increasing balance sheets, ECB, the Bank of Japan, and the Bank of England recently. What was quantitative easing 3? Less than $80 billion. We're at $200 billion. That is phenomenal. But what they're doing is they rotate it. So it was now the Bank of England's in. It was the Bank of Japan and ECB. It'll eventually be the United States' turn. As long as the fiat currencies, and remember, 95% of the world's currencies are Bank of Japan, the sterling, the euro, and the dollar. If you can rotate them around, there's no place to run other than, as you say, hard currencies and outside that game. But at some point it implodes. And it is right now, it's enrich thy neighbor that's going on. It's the Bernanke doctrine that he proposed, 4 or 5 years ago?
Almost everything in Keynesian economics is short-term with terrible long-term consequences. They remember from college when one of their professors said, or quoted Keynes as saying, in the long run, we're all dead. And they took that to heart. So all of their policies are based on how to get through the next year. And don't worry about what comes after, because in the long run, we're all dead. Well, we're living in previous Keynesian economists long-term now. And we're suffering the consequences of their policy mistakes. And the guys in charge now are just making bigger and bigger policy mistakes that we, a few years from now, or our kids, are going to have to deal with. So the idea that tweaking a system in the short run to keep it in a fictional equilibrium is all you need to do if you're a government running an economy is profoundly mistaken. And historians are going to have a field day with the incompetence of Bernanke and Greenspan and Janet Yellen and the people running the ECB and the Bank of Japan. These guys are the Herbert Hoovers of this generation. And eventually that fact is going to become clear, and might not be for a while, but again, it might be soon, because the mistakes they're making and the policies that they're pursuing are based on such obviously flawed models that it's hard to believe that we continue for much longer thinking that we're on the right path and that we're doing the right thing.
Yeah, the history books are going to talk about this era for 100 years. And everybody's going to say, how stupid could they have been?
They are. And how stupid were we for believing in them,
So, and then they would say, but nobody saw it coming. But maybe we should put this in a time bag somewhere and say there were people that really could see it. John, we have to break. We went on a little too long, but a great discussion. So much to catch up on. Could you tell our listeners just how they could follow all your great missives that you put out on a regular basis, and how they can sign up for them for email?
Yeah, I run dollarcollapse.com, which is a site that covers a lot of this stuff. And you can sign up for continuing updates at the site. Just put your email address in, and your email box will start to fill up with stuff from me.
Talk to you again next month.
Thanks, Gord. See ya.